Good evening, everyone. How are you all? I hope you are doing good, getting yourself prepared for the upcoming exams. Yep. So we can see Jyoti is there, Vedika, Abhinaya, Sapna, Jnanesh, Geet, Alok, Nitesh, Sapna, Abhishek. Good evening, everyone. I hope you are doing good. You are getting yourself prepared for the exams. We're just 3 months away from the exams, right? Almost even less than 3 months. That's the timeline that we have when you will be facing your final exams. I hope your preparations are up to mark and almost on the verge of completion of the syllabus, right? And getting a hang of your writing skills, your drafting skills. Okay, so we have started with the subject financial management, and we have done quite a few topics in it. Now, today's session, we are going to dedicate towards the capital structure part. Okay, so hope everyone has joined, and yeah, so we'll be starting with this topic of capital structure as today. It's going to be a very interesting topic, and also we need to be looking at few questions. By the way, I would request you to please download this question sheet from the portal that I have already uploaded. I would request you to please download it. Yes, that will be easy for us to go through the questions and solve it. Okay, Alok is asking some doubts, and I have a doubt in chapter 4, cost of capital in calculation of weighted average cost of capital retained earnings are also taken in the book, and solution of previous year question, it is not taken into consideration. Alok, I would request you to ask it to the respective faculty because I don't think I have taken this topic. So I would request you to ask this question in the respective faculty's class because he or she would be the appropriate person to answer you. Okay, so I may not be the correct person to answer this at this moment. Okay, you can definitely ask the topic doubts on the topics that I am taking. Okay, fine guys. So we'll be starting with this topic called as financing decisions as capital structure. Okay, so what's this capital structure and how do we go about this chapter? This chapter is very conceptual chapter, guys, which is going to be divided into two parts. One of the parts is going to be addressing, one of the parts is going to address a very basic doubt as to what should be the capital structure of my company. And the second thing is going to be based on how do we go about, working around some theories or some debates that we'll be discussing. So that's not a part of our today's agenda. Today's agenda is discussing the practical questions or capital structure problems is what we are going to look at. Then the capital structure theory will be the next session's agenda. So as of now, we're looking at some capital structure problems and we have some concepts coming up on our way. Now, let's do one thing. Let's understand what this chapter is basically all about with the help of an example. Now, suppose we have certain amount of funds to be raised. Okay, we want to raise 10 lakh. We want to raise money to the extent of 10 lakh. Now, to get this money, we have got different proposals of raising that money. So, one of the proposals that we say, first plan is to go for a equity fund of 10 lakh. Second plan is to go for a 50-50 fund, which is 5 lakh equity and 5 lakh debenture. And our third proposal that we have, third plan that we place is having 2 lakh in equity and then debenture of 4 lakh and preference shares of 4 lakh. So that totals up to 10 lakh as the total funds to be raised. The total funds we are raising anyways 10 lakh from either of these three sources. 10 lakh, 10 lakh and 10 lakh are the three ways. And obviously what is different is the structure of the capital. Remember, the capital employed in the business, the capital required in the business is the same thing. Capital required in the business is the same thing, that's 10 lakh. However, what is different is the structure of this capital that we are raising. Structure of the capital that we are raising, that is going to be different. Okay. Now, how do we decide as to which plan should we be choosing? Should we be going for plan 1 or plan 2 or plan 3? That is what to be discussed, or that is what we have to decide. Now, how do we go about taking such a decision as to which plan should we choose? So first and foremost, we need to understand that, sir, if I want to decide, I need to prepare the income statement. Okay. By the way, we are aware of this income statements, which starts with EBIT. We're not considering the sales and all, which is quite obvious, right? Because you go with plan 1, 2, or 3, it actually doesn't matter whether you are raising money through equity or through debt or through preference share, right? Whether we are raising equity, whether we are raising the funds through equity, debt, or preference share, it is just that funds that you require, those are raised from any sources. You invest into the business is going to give you the same amount of earnings before interest and tax. It's going to give you the same amount of EBIT. What will be different will be obviously the profit after tax, net profit for equity shareholders, and all such things. However, EBIT, because business will give you some return that's irrespective of where you are getting the funds. So you raise this 10 lakh from either of these sources, and what we see is that the funds that are going to be raised are from whatever source, the EBIT is going to remain constant. So let us consider an EBIT of, let us consider EBIT of 3 lakh being generated by this business irrespective of funds where you are getting it. Now, of course, if you just try to draft the income statement, we would be in a better position to typically answer it. So if we draft the further part, we can say, sir, EBIT remains same. However, let's talk about interest. Can you tell me, guys, what will be the interest amount? In plan 1, of course, there's going to be no interest. In plan 2, we are going to have an interest on this 5 lakh at the rate of 10%. On this 5 lakh at the rate of 10%. So that translates to basically 50,000. Right? And in case of plan 3, we can say that interest is going to be 10% of 4 lakh, which is 40,000. Now, after subtracting it, the profit before tax that we get is 3 lakh in plan 1, 2 lakh 50,000 in plan 2, and 2 lakh 60,000 in plan 3. And then tax, we can say tax at the rate of 30%. That's going to be 90,000 is 2 lakh 10,000. And then 2 lakh 50 is multiplied by 30%. So that should have a tax payout of 75,000, making it a PAT of 1 lakh 75,000. Okay. Then we subsequently say that the tax amount in plan 3, what will be the tax amount in plan 3, guys? Tax amount in plan 3, that's going to be 2,60,000 into 30%, so that's 78,000. And that makes the profit after tax figure to be 1,82,000. Right? Preference dividend, we don't have anything over here, neither over here. But since we are issuing some preference shares over here, 4 lakh, we can say that 4 lakh multiplied with 12%. So 4 lakh multiplied by 12%, that should give us a preference dividend of 48,000. Then we can say net profit for equity shareholder. It is 2,10,000 over here, 1,75,000 in the second plan, and in the third plan we are going to have it as 1,34,000. Number of equity shares over here. Let us say each share is issued at a fair value, at a face value of 10 rupees. So 10 lakh divided by 10, that amounts to number of equity shares being just 1 lakh. And then this is second case, the number of equity shares is going to be, since it's 5 lakh, that count is going to be just 50,000. And in the third case, that's 20,000. EPS, obviously, we are going to divide this with the number of shares. So 2,10,000 divided by 1 lakh. That gives us an EPS of 2.1. Second case, the EPS is 3.5. And third case, the EPS is 6.7. If I ask you which company is really doing good with regards to its earnings per share, with regards to its earnings per share, you will find that it's 2.1, 3.5, and 6.7. So undoubtedly, it is this company with a EPS of 6.7, which is doing good, right? Is doing good. That's 6.7 being the earnings per share. So company C is doing good, or plan C, or third plan is basically doing good. However, if I ask you, look at these three plans and look at the capital structure. Can you tell me which plan is having a greater capital gearing? Which plan is having a greater capital gearing? Yep. Tell me, guys. I'm waiting for your answer. Which plan of the three is having a capital gearing to a greater extent? Which plan is having capital gearing to a greater extent? Yeah. Is it plan one? Is it plan two? Is it plan three? Which plan has got a greater degree of capital gearing? Which plan is having a greater degree of capital gearing? Of course, you would have seen the capital gearing ratio, guys. Capital gearing ratio is debt plus preference share capital upon equity, which is 8 by 2, which is 4. The company is actually running in the fourth gear. Third plan is making the company to have a greater gearing. A higher degree of gearing is there in plan 3, right? So greater degree of gearing is there in plan 3. Of course, if it has a greater gearing, it has a greater risk also. So because of higher risk, will the investors, will the equity shareholders have more confidence in the company, or are they going to have less confidence in the company? Tell me. Because of this higher gearing, are the investors, are the equity shareholders going to have higher confidence or lower confidence? of course, they are going to have a lesser amount of confidence. And therefore, the price to earning ratio that you see over here, since the first plan is having the least risk because it's fully equity, there's no debt involved in it. So investors have a greater confidence. The PE ratio, price to earning ratio of 15. Second plan, there's a PE ratio of 11, which indicates that somewhat lower level of confidence, right? And third plan is having this, gearing of, since it was having a greater gearing, it's going to have a lesser degree of confidence. And that's why the P ratio is 5. I hope you're aware of the P ratio concept, right? Because P ratio was market price per share upon earnings per share. If I ask you what should be market price per share, that will be multiplied with EPS. So we have the earnings per share and P ratio as 15. We have earnings per share and the P ratio as 15. And over here it is 3.5 and 11 and 6.7 and 5. So can we get the market price per share? Yes, surely sir, we can get it by simply multiplying both of them. So if you multiply EPS and P, so 15 into 2.1, that will give us 31.5. Then for the second case, that's going to be 38.5. And for the last case, we have the market price per share as 33.5. Yeah. Based on this, which plan is the best for the creation of wealth for the equity shareholder? Which plan is best for creation of wealth for equity shareholder? Yeah, obviously it's going to be this plan. It's 38.5 with the price of 38.5. Uh, the plan 2 is going to provide us the highest market price, and that's where the company should look for raising funds in this ratio of 50-50. That is 50% debt, 50% equity. So what's the rule that we have set forth? To decide which financing plan to be chosen, we should consider earnings per share of each of the plans. We are going to consider EPS for each of the plans and select the plan which has the highest EPS. However, if the question gives you another level of information, if the question provides you another level of information about the price to earning ratio, it provides the information about price to earning ratio, then we should consider market price per share as the selection criteria for the financing plan. If P ratio is given, we should consider market price per share as the selection criteria for the financing plan. Okay, so primary criteria is to go for highest EPS. If the question provides you additional information as to what will be the P ratio, then you should go down one step and then go for calculating the market price per share. Okay. Okay, guys. Are we good? So this is a technique that we have. So that's how we are going to work on it. Right now, market price is 33.5 guys, because this is 6.7. Okay. Miss Uma Priya, the earnings per share is 6.7. And on that basis, market price is 33 point. Okay, fine. So that's the very introduction part as to how do we go about first solving it. So to get a hang of it, let's just try to work with a question, which is this question number 1. Question number 1 from the handout that I have shared, that I've shared on the portal. I request you to open this file so that we can begin solving question 2 of this. Meanwhile, I'll just also set up Excel for this. Yeah, I'll just write it in the Excel so that it suits to the best extent. Okay, I have the question also over here. Question number 2. I hope everyone has opened up the question file which I have shared. Yeah, so we can begin with the solution then. Ready, guys? Okay, chal, let's begin. Let's look at this question 2 and try to solve it in a best possible way. The existing capital structure of XYZ Limited. The existing capital structure for XYZ Limited is as under: equity shares of rupees 100 each, 40 lakh, retained earnings 10 lakh, 9% preference shares 25 lakh, 7% preference share, 7% debentures of 7% debentures of 25 lakh. Okay. The existing rate of return on company's capital is 12% and the income tax rate is 50%. The company requires a sum of 25 lakh to finance its expansion program, for which it is considering the following alternative. Okay, so let's talk about what is the existing capital structure of the company. As of now, how much is the capital that the company is having? What is the amount of capital that the company has? You can say that is 40 plus 10 plus 25 plus 25, 1 crore. So 1 crore is the existing capital of the company. Okay. And what we can say is that it wants another 25 lakh for its expansion purpose. It requires another 25 lakh for its expansion purpose, and for which it is looking at 3 options. One is to raise through equity shares at a price of 25. Second is to go for a 10% preference share, and third is to issue 8% debenture. And for all the 3 plans, we have got some P ratios also. So simply speaking, we have got 3 plans. So we've got 3 plans to be dealt with. Say particulars. We have for plan 1, and we have plan 2, and we have plan 3. For all the 3 plans, we need certain numbers. Let me just convert this into currency. Just have it in currency terms only. Yeah. Okay. So let's write down the existing capital. The existing capital. In the existing capital, we are having equity share cap. We're having equity share capital. Then we also have the reserves. The company has got 9% preference shares. And also we have the 7% debentures. Okay, this is the existing capital. So just write one thing. Existing, we have got equity share capital 40 lakh. Right? Equity share capital to the extent of 40 lakh. And we have a reserves to the extent of 10 lakh. uh, 9% preference share to the tune of 25 lakh. 25 lakh, and then debentures to the amount of 25 lakh. Now, going to plan 1. In plan 1, we intended to raise the additional funds by way of equity shares. So by issuing 20,000 equity shares at a premium of rupees 25. So can you tell me, guys, what will be the amount of equity share capital going for plan 1? What will be the amount of equity share capital? Is it going to be 40 lakh plus 25 lakh? Of course, no. It's not going to be 40 lakh plus 25 lakh because 40 lakh is the original one. We are issuing shares at a price of 25 each. We're issuing shares at a price of 25 each. Not at a 25, but at a premium of 25 each. So basically, equity share capital, we can say this is the original one was 40 lakh, but what will be the new one? What will be the new one? Can you tell me what will be the new amount of share capital? By the way, the new amount is going to be simply 40 lakhs plus. The new amount is simply going to be 40 lakh, original 40 lakhs plus we are having additional capital of 25 lakhs. But remember, these 25 lakhs are issued at a premium of rupees 25. So 25 lakh is the amount that I'm going to multiply it with by 125 and sorry, divide it by 125 and multiply it with 100 so that we make it as a face value thing. Right? That we make it as a face value thing. So as per plan 1, what will be the amount of equity share capital? See if anyone has answered. Yeah, correct. Any have answered? That's going to be surely 60 lakhs. Okay, 60 lakhs. Remember this particular portion over here, 25 125 divided by 125 is actually indicates the number of equity shares. Okay, the 25 lakh divided by 125, it indicates the number of 25 lakh. Just remember this. Okay, then in the plan 1 itself, the reserves, original reserves, it continue. It will be continuing to be 10 lakh, but there's obviously new reserve is going to be 10 lakhs plus, that's going to be 10 lakhs plus, uh, you see 20,000 equity shares are issued at a premium of rupees 25. So each share you are having 25 as premium, rupees 25 as premium multiplied by 25 as premium multiplied by the number of shares again. Now, how many shares are basically issued? 20,000 shares, right? 20,000 shares. So this is going to be basically 10 lakh plus additional 5 lakh over here. So you can say that's 15 lakh as the new shares. What we can also say, that instead of doing this, and simply write it over here. $25 lakh divided by 125. We need not show this because we already know that it's 20,000 shares into face value of rupees 100. 40 lakh plus 20,000 into face value rupees 100. That's pretty simple to look at it. Now, of course, in plan 1, since we are issuing equity shares, the preference share and the debentures are one and the same. Right? The debentures are one and the same. And then we say some amount of as total capital employed after the expansion program will be, of course, sum of all of them. Earlier it was 1 crore. Now in plan 1 it has become 1 crore 25. Now going for plan 2. In plan 2, the equity shares will remain as it is because we are anyways raising it by way of preference shares. Okay. Reserves would continue to be same 10 lakh, and the preference shares is going to be a different figure because we are issuing some additional preference shares, and the new preference shares, they carry a dividend rate of 10%. So we have a new instrument, 10% preference shares. %10 preference shares, which is entirely 25 lakh. Right? And then after 7% debentures, we have got the 8% debentures, and that 8% debentures, of course, we don't have it in this plan. We have it in the other plans. Now, of course, in plan 2, the original preference share and original debentures would continue to be there. So making the total capital as 1 crore 25 lakh. But then you see that, since the total capital is 1 crore 25, that additional 25 is due to the additional 25 lakh from the preference shares. Now in plan 3, the equity share capital continues to be same as original. The reserves will continue to be same as original. Preference share will continue to remain as it is. 7% debentures will remain as it is, but we'll have a 8% debentures criteria new, and that's going to be 25 lakh. And it'll make our total capital structure to be total capital to be reaching up to 1 crore 25. So these are the 3 capital structures that we have. 3 capital structures. Based on these capital structure, we have to give an information about which plan are we going to choose, whether it's going to be plan 1 or 2 or 3. Of course, since we have in the questions the P ratios given to us for all the 3 plans, we have to boil down up to, not only the earnings per share, but we have to go up to the market price per share. So we need to prepare the income statement beginning with earnings before interest and tax. Then we are going to subtract the interest and that interest is going to be 7% of um, 25 lakhs. And we also have interest, which is, no, we may have 8% of 25 lakh. This is going to be in different plans, right? So after EBIT, we subtract the interest and then we get profit before tax. From that, we are going to reduce the tax so that we get a profit after tax. From that, we are going to reduce the uh, preference dividend. But remember, again, we may have two classes of preference dividend in one of the cases in which preference dividend will be at the rate of um, preference dividend was one is a case of 9%, 9% of 25 lakhs, and we may have one more preference dividend at 10% of 25 lakhs. Then we will get the net profit for equity shareholder. We'll divide this by number of equity shares so that we get earnings per share. Then we write down the PE, and then we finally get the market price per share. Now, of course, EBIT, you raise the money from either of the sources, by equity or by debt or by preference share. So EBIT is going to remain constant. And what's the EBIT amount, by the way? The amount of or the rate of EBIT given is, see over here. The existing rate of return on company's capital is 12% and the income tax rate is 50%. So EBIT is going to be 12% of total capital employed. Going to be at the rate of 12% of total capital employed. Okay, so that's going to be 12% of total capital employed. Now, we have to obviously evaluate plan 1, 2, and 3. So we'll say it's going to be this 1 crore 25 lakh, 1 crore 25 lakh multiplied with 12%. That remains the same or irrespective from wherever you get the funds. Now, talking of the interest, in first plan, since it's a fully equity, we are not raising this additional funds by debt. Over here, we are going to have it as 0. However, interest will continue to be at, on this 25 lakh at the rate of 7%. And then we have a profit before tax as EBIT minus both the interest. Yes. Tax, it is at the rate of, given in the question, tax is at the rate of 50%. The tax is basically going to be this into 50%. We have a PAT of EBIT minus tax continues to be same as the tax figure. Preference dividend, 9% of the preference share capital. That's preference share capital multiplied with 9%. And of course, there is no preference dividend for the 25 lakhs. So we've got the equity share capital, net profit for equity share capital as PAT minus this. Then we have the number of equity shares. Number of equity shares is basically this figure, 60 lakh divided by 100 each. We say that's going to be 60,000. And of course, this is not in rupee terms. This is the actual general cheese, or I can say this is the number. Okay, so EPS, that will be 4,37,500 divided by number of equity shares. It will not be exactly 7, though I'm getting it in the same way. That's 7.29. Then in the second case, 15 lakh being the EBIT, from that we have to subtract the interest component. And here we are going to have the second plan is by way of preference shares. The interest will continue as the same. So PBT is going to be 15 lakh minus this. Tax is going to be the PBT multiplied by 50%. The PAT is going to be PBT minus the tax. And preference dividend is going to be, we're going to have two sort of preference dividend. One on the original preference shares at the rate of 9%, and second on 10% multiplied with the 10% of 25 lakh. We would have a net profit for equity shareholders by subtracting this. We will subtract further, we'll have 50. We have a net profit as this, and of course the number of equity shares is 40 lakh, originally 40 lakh divided by 100. And here we have EPS as probably around 5 rupee, or 4.69 is the EPS. And in the third scenario, we'll have both the interests. So one is interest on this 25 lakh at the rate of 7%, and another 25 lakh at the rate of 8%. So we have PBT as EBIT less this interest, and further subtraction of this 8%, 25 lakh. 11 lakh 25,000 is a PBT. Tax is this multiplied by 50%, and then PBT 5 lakh 62. Now preference dividend is 9% multiplied by is 25 lakh. There's no preference dividend of 10% because that was the second case anyways. Net profit for equity shareholders is going to be PAT reduced by the preference dividends, and number of equity shares is going to be the equity share capital divided by 100, which is 40,000 shares. And we have the number of equity shares after consideration of net profit. That's going to be this figure as EPS is 8.44. So with regards to EPS, the clear winner is plan 3. But wait, picture abhi baki hai mere dost, because we still have the two more parameters to be checked. One is the P ratio and the market price. P ratio and the market price, if you look at it, P ratio is given as 20, 17, and 16. So market price is basically the 7.29 multiplied with 20, and same way I have to do it for the other two areas. If I consider the P ratio, if I'm considering the P ratio, market price per share is 146.80 and 135. So may not be exact. I would like to just bit, yeah. So that's 145.83. So it's a clear case of winning by way of the first plan is a clear case of winner, because we need to be raising the funds by way of equity shares, because that's going to ensure that we are providing the best possible value to our equity shareholders, and the wealth of equity shareholders will be highest in this case. Okay, so that's 145.83. Okay, let me look at the question chat box. Do we have any queries? Why are you taking existing column? Pramod, we are just writing the existing column to compare, or easy for us to write down what we are going to have in the proposed plans column. Okay, are we good, guys, with this question? Is this question fine with you? Does it gel with you? Is it good? Yeah, clear. It's quite simple. Nothing difficult at all in this. Yep, clear. There's no name for this statement. It's just evaluation of the financing plans. That's it. We call it as evaluation of financing plans. Yeah, sure. Okay, fine. So now let's go for one more question before we go for some additional concepts in it. You can just write the conclusion over here. Since the market price per share of each share is highest in plan 1, the company should raise money through equity shares. The market price of each share is highest in plan 1. The company should raise money through equity shares. Okay. Okay. Part B of this question. Give reasons of your choice. We give the reason that market price being the highest. Ani Agarwal, yeah, I'll upload this solution. You need not worry. I'll upload the solution to the question. What about part B? Part B is done. EBITDA is given to us, so we need to deduct depreciation from it first. Then this step continues. You need not deduct. Okay, if EBITDA is given, then of course you need to deduct the depreciation and amortization, and then you have to proceed accordingly. Okay, sure, great. So we have got this solution for the first question, for the second question basically. We haven't done the first. Now let's go for question number 3. Let's read through question number 3 and then we'll try to work out the answer for it. Let's read this question number 3 first. XY Limited provides you the following figures. XY Limited provides you the following figures. Profit, EBIT of 2,60,000, less interest on debentures at 12%, 60,000. Profit before tax of 2 lakh. Income tax at the rate of 50%, 1 lakh. Profit after tax of 1 lakh. Number of equity shares being 40,000 and earnings per share as 2.5. Ruling price in the market is 25. P ratio, that is price to EPS, is 10 rupees. That's 10 times. The company has undistributed reserves of 6 lakh. The company needs 2 lakh for expansion. And this amount will earn at the same rate as the funds already employed. We need to first get what is the current rate of return that the company is generating. The company needs 2 lakh for expansion. This amount will earn at the same rate. We are informed that a debt equity ratio, that is, remember this debt to capital ratio given over here, that's a bit different thing. Here, the debt to capital ratio, they say debt to total capital. Even though they are saying debt equity, but they have clearly specified in brackets that that's debt to total capital. Debt to total capital is higher than 35%. Debt to total capital being higher than 35% will push the P ratio down to 8. It's going to push the P ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. You are required to ascertain the probable price of the share. For all the three plans, or not basically plans, we are looking for some plans, that is, an additional funds are raised as debt, or if you're raising the additional funds by issuing equity shares. So we've got two plans to evaluate. One is by raising the required money by way of debt, other is by raising the required money by way of equity. Under both the plans, we need to check what is the probable price of the share. So for that, I need to first get what's the capital structure as of now and what's the rate of return that we are earning as of now. Okay, so we need the current capital structure, current EBIT, to provide us the return on capital employed. We have existing, and then we have a plan 1. Let's call it as a debt plan, and plan 2 as equity plan. Okay, so let's talk about the existing capital that we have. Existing capital is equity share capital. We've got some reserves also that's stated in the question. And then we have some debentures also. Okay. So equity share capital, I need to look at it by simply look at this number of equity shares given in the question. Number of equity shares 10 each, and that number of shares is 40,000. That actually makes it as 40,000 multiplied it with 10. The existing capital we have 4 lakh. Reserves is 2 lakh. And debentures, we need to look at interest on debentures at 12%, which is 60,000. Interest on debentures is 60,000. So debentures is going to be 60,000, right, divided by 12%. So as of now, the total capital that we have is 11 lakh. The total capital employed is 11 lakh. Okay. One second. Reserves, it's my bad. Reserves is undistributed reserves is 6 lakh, guys. 15 lakh is the total capital employed as of now. Now we want to raise additional 2 lakh. We want to get additional 2 lakh, and that 2 lakh can be raised by way of equity or by way of debt. That can be raised by way of equity or by way of debt. If you are raising it by way of debt, the rate of interest is going to be dependent on the additional amount. That's going to be dependent on this debt to capital ratio. Okay. So in plan 1, since it's a debt, and the equity share capital and the reserves will continue to remain same, and the existing debentures will remain as it is. but I need to be very sure about what will be the rate of interest. So debentures at 12%, or is it going to be a case that debentures are going to be at the rate of 14%? Debentures at the rate of 12% or at the 14%. For that, as I said, we need to compute the ratio. That ratio is simply going to be debt to total capital. Debt to total capital ratio. Now, in the debt to total capital, since we want 2 lakh as the debt, so let's compute the debt to total capital. If we take the debt as the existing debt is 5 lakh. Now, of course, the new debentures, let's keep this rate of interest in an open situation, because that will actually be decided on the basis of our ratio. Let me just write this 2 lakh over here. And total capital employed will be 17 lakh. Debt to total capital, we can say, so since debt is going to be the total debt, which is 7 lakh, divided by the total capital employed. So this ratio, this number is actually 41.18%. So what will be the implication? We can say, sir, this is greater than 35%. This has turned out to be greater than 35%. This has turned out to be greater than 35%. So since this is greater than 35%, what is the implication that we have? It has got two implications. It's got two implications. One implication is that debentures will now be borrowed, or debentures can be issued at the rate of 14%. And the second implication is about the PE ratio. The existing PE ratio is 10, right? However, since your debt to total capital is above 35%, the PE ratio is going to be reducing to 8. Okay. So we have that implication because of this PE ratio. The debt, this number actually makes our debentures as 14%. And the other thing that this thing makes is, it also causes our PE ratio to be 8. Okay. Now, going for the second plan, which is all equity. Again, at what price can we issue the shares? Of course, since it's an equity plan, we can, the question is silent about how you can raise at what price you can raise the funds. So we're saying that let us say we are going to issue the equity shares by way of at a market price, at whatever is the market price. So we can say the market price is, ruling market price is 25. So we would actually get the number of equity shares by considering the market price. Over here, we can simply show a calculation as, what's the funds that we require. Funds required is 2 lakh. And market price of share is 25. Can you tell me what will be the count of number of equity shares? That's going to be 2 lakh divided by 25. That's the 8,000 shares. Now, against this 8,000 shares, we will have equity share capital and we will have securities premium. Equity share capital will be 8,000 multiplied by 10 rupee. Securities premium will be 8,000 multiplied by 15 rupee, right? So our equity share capital is essentially going to become 4 lakh plus the equity share capital of 80,000. Okay, you can simply say that this has got linked with this number. Then the reserves. Originally the reserves were 6 lakh and add to it reserve of 1,20,000. Okay, so reserves are again, they are added from over here. Then the original debentures as they were, they will continue as it is. And then we have the total capital employed as 17 lakh. Okay, so total capital employed works out to be 17 lakh, 15 lakh, 17 lakh, 17 lakh. Okay, total capital employed 15, 17, 17. So we've got a proper thing. And over here, one thing we are still yet to do is what will be the total debt to capital. Since over here, total debt is only 5 lakh divided by 5 lakh divided by, total capital of 17. Now, of course, this is a fairly lower number, 29.41%. And for that reason, the P ratio is going to be 10. So anyways, no new debentures are issued, so interest rate won't be affected. So that's about the capital structure. Now, over here, we'll talk of the return on capital employed. We had a EBIT, earnings before interest and tax, in the existing plan to the tune of 2,60,000. EBIT to the tune of 2,60,000. And then we have return on capital employed, because we need to have this return on capital employed figure because that's going to remain same irrespective of which plan you choose. Irrespective of which plan you choose. So 2,60,000 divided by 15 lakh. So we have this return on capital employed to be, 17.33%. Right? So current ROC is 17.33%, and this 17.33% is going to be applicable for both the plans also. Right? Similar ROC is going to be there for both the plans. So if we talk of now EBIT to begin with, evaluation of both the plans, that's going to be 17.33% of the total capital employed, which is 17 lakh. And that's even true for the second case. Right? So even for the second plan, our EBIT is going to be there as a similar figure. Right? So 2 crore 2,94,667 is the EBIT. From that, we are going to reduce the interest. Interest will be the first plan, since it's a debt, 5 lakh multiplied with 12% plus we'll also have this 2 lakh multiplied with 14%. 88,000 will be the new interest, will be the interest in the plan one, and the interest in the second plan is going to remain same as it's a case of original, which is at the rate of 12%. Profit before tax. is 2,94,667 minus 88,000. And this is 2,34,667 as the profit before tax. From this, we definitely subtract the taxes. So we have less taxes, and then we get the profit after tax. We consider the number of equity shares, we get the EPS, then the P, and the market price per share. The taxes are this multiplied with. Now, what's the tax rate? Tax rate, as you can observe from the question, that's it's 50%. PBT multiplied with 50%. Same goes for second plan. PAT is PBT minus taxes. Number of equity shares is going to be the share capital divided by 10 rupee, right? And earnings per share will come out to be the PAT divided by the number of equity shares. P ratio, as we have written over here, that's going to be 8 and 10. Both these EPS figures, I just need to make it as decimal thing. Market price per share is 2.58 multiplied by the P ratio. We get this figures as the market price per share. Again, I'll just reduce the decimal. Market price per share 20.67 and 24.44. So under both these plans, 20.67 and 24.44, market price is of course higher in the second plan. So funds should be raised by way of equity, right guys? We'll say since market price per share is highest, always higher in plan 2, funds should be raised by equity shares. Funds should be raised by equity shares. Okay. Is this clear, guys? It was actually a combination of analysis of P ratio along with the debt to capital. So since higher debt to capital will induce lower confidence of the investors, and therefore you see that the P ratio is lower. Yeah. So let me take the queries. Why we calculate ROC? Why are the shares issued at premium? The question says, let's see, the question says that the amount will earn the same rate as the funds already employed. The question states over here, the amount will earn at the same rate as the funds already employed. So it means we need to know what is the rate of return that the firm is generating as of now. The rate of return which the firm is generating as of now. So that will be like existing EBIT divided it by the total capital employed as of now. So in the original scenario, we find that the total capital employed was 15 lakh and EBIT was 2 lakh 60. So we were earning 17.33%. That same rate of earnings is going to be there for plan 1 as well as for plan 2. Same rate of growth or rate of earnings is going to be there for plan 1 as well as plan 2. And for that reason, return on capital employed is to be computed, because only after this we will be able to know what will be the new EBIT in the plans. Okay, why shares are issued at premium? Because there is a ruling market price available. So we are making an assumption that shares will be issued at a market price. Okay. So the question had this income statement given to us, and it asked us that if you go for additional funding of 2 lakh, the question had this income statement already, profit of 2 lakh 60, and then it translates to EPS of 2.5. Whatever was the existing capital, the question asked that suppose if you bring in additional 2 lakh into the business, what will be the resultant impact on the share price? And these additional 2 lakh were brought in by way of two routes. One by way of equity shares and other by way of debt. Now the question also states that if you're taking more debt, like over here, debt to total capital, if the debt to total capital ratio is higher than 35%, if debt to total capital ratio is greater than 35%, then obviously it is a greater risk. And for that reason, the P ratio will go down, and interest on the additional amounts that you borrow will be costing you 14%. And only for that reason, we tested over here that if I raise this 2 lakh by way of equity shares, if I raise this 2 lakh by way of debt, then we would calculate what is our debt to total capital ratio. That was obviously 41.18, which was higher than the threshold set, which is 35%. That actually made the new debentures costing us 14% and the P ratio going down to 8. Okay, and then plan 2 was about raising it through equity shares. So since it was through equity shares, we wanted 2 lakh. We wanted 2 lakh as additional funds. Each share was to be issued at a market price of 25. So we meant 8,000 shares will be issued. The equity share capital will be 80,000 and securities premium will be 1 lakh 20. That's like the number of equity shares multiplied by 10 rupee face value of each share. Okay. And then the balance, you can say 15 rupees the share premium. That share premium goes to reserves. 80,000 goes to the equity share capital. Okay, so we have this, and then later on we have computed the return on capital employed. That return on capital employed was to be held, or that's going to be there for both the plants, one as well as two, and that makes us a EBIT calculation as whatever is your return on capital employed, multiply it with total capital employed, and then going ahead, you just have to go ahead and calculate the EPS and the market price per share. Okay, EBIT will be 294610. Yeah, it can be due to some rounding up error and nothing different about it. Are we good, guys? Sharan, are you good now? Sharan, Prachi, did we get it? Yeah. Is it clear? Is it good, guys? All clear? Yeah. Okay, great. Fine. So let's just do one thing, guys. Over here, let's take a break. Let's take a break, guys. Break of 10 minutes, and then we'll begin with some new concepts in this chapter. We'll be discussing something called as financial break-even point and financial indifference point. Okay, that's going to be really interesting stuff. Let's take a break of 10 minutes. We'll be back by 7:25 possibly. Yeah. Okay, welcome back, guys. Uh, Sharon is asking why new debenture? The plan itself, Sharon, by issue or additional funds are raised as debt. Those debt we have taken it as debentures. So 2 lakh debt over here. How did you get 17.33? Prachi Kapoor, Rarosi is EBIT upon total capital employed. So EBIT of 2 lakh 60 divided by original 15 lakh. Okay, I hope I have answered your both the queries. Now let's go for uh, some more conceptual things now. Let's talk about financial break-even point. Financial break-even point. Okay. Let's say over here, uh, you know, break-even point, it is that level of sales. Break-even point is that level of sales at which your profit is zero. Or we say that it's that level of sales at which your revenue and cost is one and the same. Make no profit, no loss in that scenario. So, as a point, financial break-even point, it simply means the EBIT at which your net profit for equity shareholders is going to be zero. What's that EBIT, sir? EBIT simply means it is that level of EBIT at which net profit for equity shareholders should be zero. So let us consider, this income statement over here. You consider a EBIT of 35,000, interest of 10,000. So we get a PBT of 25,000, tax of 10,000, PAT is 15,000, preference dividend is let's say 15,000. So we find that net profit for equity shareholders is zero. So this 35,000 is actually what we mean by the financial break-even point. 35,000 is what we mean by the financial break-even point. So at this EBIT level, we find that the net profit for equity shareholders is zero. Now, how do we get this 35,000? We'll calculate that in a short while. But I just want you to understand that suppose instead of 35,000, we had this EBIT as 40,000. That is, our EBIT is greater than the break-even. And interest is 10,000. Interest will continue to be 10,000. When your EBIT changes, it doesn't mean that your interest is also going to change, right? So EBIT of 40,000, interest of 10,000. So profit before tax will work out to be 30,000. Tax at the rate of 40%, we can say that it's 12,000. Profit after tax is 18,000. We have a preference dividend of 15,000. So we find that we have a net profit available for equity shareholders as 3,000. Similarly, if I ask you uh, what will be the net profit for equity shareholders, if suppose your EBIT figure is 30,000, interest continues to be 10,000, so we find profit before tax is 20,000. Tax at the rate of 40% should work out to be 8,000, and your profit after tax is 12,000. Preference dividend is supposed to be 15,000 to be paid. We find that net profit which is available for equity shareholder, that is totally wiped out, and it becomes 3,000, right? So what can be our observation? I want inputs from you. under what scenario you find that your net profit for equity shareholders turn out to be negative? Which is that scenario at which your net profit for equity shareholder turns out to be negative, and which is the scenario at which your net profit for equity shareholders turns out to be positive? And I would like to add to this, which is that scenario at which there is, net profit for equity shareholder is zero. Yeah, tell me, guys. Tell me, which are these three scenarios? At which scenario, in what condition or in what situation, net profit for equity shareholder is zero, and under what situation net profit for equity shareholder is negative or positive? I don't want the cases 1, 2, 3. I want the scenario, the relation, or let me make it even more clearer. I want the relation between EBIT and financial break-even point. What is the relation between EBIT and financial break-even point? EBIT and financial break-even point. What's the relation? Okay, when EBIT is less than break-even point, we incur losses. So when your EBIT is less than financial break-even point, net profit for equity shareholders is negative. And when your EBIT is equal to financial break-even point, then your net profit is zero. And when your EBIT is greater than financial break-even point, you find EBIT is less than financial break-even point, then you have a negative. And when it is greater than financial break-even point, you have a positive net profit for equity shareholder. Okay, are we clear with this underlying thing? We clear with this, guys? So your EBIT being greater than or less than or equal to your financial break-even point, that will decide whether it is giving you positive or negative net profit for equity shareholders. Okay, so what's the financial break-even point? Two sentences. First, it is the amount of EBIT at which your net profit for equity shareholders is zero. Secondly, it is that level beyond which it is that level of EBIT beyond which equity shareholders will start making profits. Otherwise, they will be into the loss. If I just try to predict, portray it by way of a chart, you can look at this. The x-axis indicates the EBIT level. The y-axis indicates the level of EPS. Y-axis indicates the level of EPS. X-axis indicates the level of EBIT. So as the EBIT increases, we find that net profit for equity shareholder also increases. But it is in a negative zone for some time period until it crosses the break-even point. Once it crosses this break-even point, then you are into the positive zone, or I can say the net profit for equity shareholders turns out to be a positive figure. We can also say that this is our net profit for equity shareholders. Okay, we can say that this is net profit for equity shareholder on the y-axis. So your EPS or your net profit for equity shareholders turns positive only if it is above the break-even point. Now the question is, sir, how did you know that it is exactly 35,000 at which you will get a net profit for equity shareholders at zero? That's pretty simple, guys. Let's try to derive the formula for the financial break-even point. Let's try to derive it, okay? So We want the net profit for equity shareholders to be zero. We want the net profit for equity shareholders to be zero. So preference dividend will continue to be called as X, and let's call the interest amount as Y. So preference dividend is X, net profit for equity shareholders is zero. What will be the PAT figure? Can we do the reverse calculation? So on our reverse calculation, we get the PAT also as X, because from that X, preference dividend X is subtracted and net profit for equity shareholders is zero. Now PBT is 100, tax is 30, PAT is 70, right? Because profit after tax will be after deduction of tax, the tax rate will be 30. Now, if I just do a cross multiplication and try to get this PBT, that's going to be X into 100 divided by 70, right? Or to be specific, I can say if PBT is 1, tax is 0.3 and this is 0.7, right? Or I can call it as, if this is 1, T is the tax rate and 0.7 is 1 minus the tax rate. So what is this figure going to be? Simply go ahead with the cross multiplication. X into 1 divided by 1 minus T. This actually works out to be X divided by 1 minus T. Since Y is to be subtracted, going ahead with the reverse calculation, this EBIT figure is going to be X upon 1 minus T plus 1. Just did a reverse calculation, guys. Right? So if I ask you, sir, if EBIT is X upon 1 minus T plus Y, then your net profit for equity shareholder will turn out to be 0. So if I just want to formulate financial break-even point formula, that's X upon 1 minus T plus Y. So that's like, what was X? X was the amount of preference dividend. Preference dividend upon 1 minus tax rate plus Y is the interest. Preference dividend upon 1 minus tax rate plus interest. Right? Yeah. So that's exactly the formula that we have for the financial break-even point. That's our exact formula for the financial break-even point. Preference dividend upon 1 minus T plus interest. Right? So this is the formula that we have used. And if I just try to work out on this, we have this interest of 10,000, preference dividend of 15,000. We just try to apply that. Preference dividend was of 15, interest was of 10. 15,000 divided by 1 minus 0.3 plus interest of 10,000. You can just try to work out 15,000 divided by 0.7. 15,000 was the tax rate. Sorry, tax rate was 40%, right? Tax rate was 40. So 15,000 divided by 0.4 basically. 0.6. 15,000 divided by 0.6. And to that, we add 10,000. That exactly 35,000 is what was our financial break-even. Right? So that's how we compute the financial break-even points or any sort of questions. So if any question is given, we can simply say what's the financial break-even point. Okay, so that's a simple formula. Preference dividend upon 1 minus T plus interest. And don't forget the implication of financial indifference point. And that implication is if your EBIT is greater than the financial break-even point, then only you will be making profits. Otherwise, you will be in the loss zone. You will be in the loss zone. Okay, fine. Now let's look at the question, which is question number 6 from our handout. Yeah, let's look at question 6. Hypothetical Limited is in need of 1 lakh to finance its increased net working capital requirement. The finance manager of the company believes that its various financial costs and share price will be unaffected by the selection of a particular plan since a small sum is involved. Debentures will cost 10%, preference shares 11%, and equity shares can be sold for 25 per share. Tax rate is 35%. So we have got 3 financing plans. First plan is all equity, which is 100% equity. Second plan is 30% equity, 10% preference share, and 60% debentures. And third plan is 50, 20, and 30 ratio. That's the 1 lakh capital that we need, for which we have these 3 distinct plans. Now, determine the financial break-even point. Which plan has greater risk? And assume a EBIT level of 50,000. Which plan is having a greater risk? And we have to decide, suppose if EBIT level is 50,000, then which plan is supposed to be having a greater risk and where are we going to get a greater return? Okay, so let's look at the solution. It's quite easy. So 3 financing plans we have. Plan one was fully equity, and one was fully equity, right? Plan one was 100% equity. Then we had the second plan in which the ratio was 30, 10, and 60. So 30,000, 10,000, and 50,000. Third plan had 50, 20, and 30 ratio. Is 50,000, 20,000, and 30,000. Then preference dividend is at the rate of 11%, and debentures was at the rate of 10%, and the tax rate was 35%. So we need to write down first the preference dividend rate. Preference dividend will be 11%, 11% of 10,000, which is 1100, and this is 20,000 into 11%. So that's going to be typical 1100 and 2200. Interest on debentures 60%, so that the 60,000 into 10%, 6,000 debentures interest, and 30,000 into 10%, that's 3,000. So once we have this debenture interest and the preference dividend, I want an answer from your end. What is the financial break-even point for all the 3 plans? What's the financial break-even point for all 3 plans? Calculate and tell me, guys. I'll wait for a couple of minutes for your answer. Calculate the financial break-even point for all the 3 plans. I'll wait for you. Just for your information, our financial break-even point is preference dividend upon 1 minus T plus interest. This is the formula that we are using. Yeah, tell me. What will be the financial break-even point? Okay, 7692, 6385. 76926385. Is it? Others, answer fast. Waiting for your answers. 76926385. Perfect, guys. You're absolutely correct. We get the financial break-even point as 7692.31 and 6384.62. Now, of course, what the EBIT required for positive net profit for equity shareholders? If the equity shareholders want a positive net profit, since plan one has got a zero break-even point, zero financial break-even point, anything above zero EBIT will give you some net profit. For plan 2, it has to be greater than this 7,692 figure. And for plan 3, it has to be greater than 6,384 figure. Okay. So, given in the question that uh, the EBIT level is 50,000. So, if EBIT level is 50,000, what can be our conclusion about it? If EBIT level is 50,000, we say that the EBIT level is 50,000. Of course, any of these plans you can choose because you'll be in the positive zone. But from the risk point of view, plan 1 has got the least risk because of the lower break-even point. Plan 2 has got a greater amount of risk, 7692.31. And plan 3 has got moderate risk, 6384.62. Plan 3 has got moderate risk of 6384.62. Okay, so higher break-even point indicates higher risk. Okay, guys, shall we go for the next concept? I hope you have got this EBIT. Shall we go for the next concept? Yep, fine. Now we have to look at another concept called as the indifference point. I'm sure you might have learned about this indifference point somewhere in economics or maybe in costing, cost accounting. Indifference point, probably in marginal costing, you might have learned or not. I'm not yet sure. Okay. So, but I'm pretty sure that you might have heard this term somewhere, indifference point. Now, what's this indifference point and what's this fab all about? Okay. So, what's this fab all about? Let us say, let me just give you the definition directly as to what's the indifference point. Uh, Indifference point is basically that level of EBIT in which both the plans have got the same amount of EPS. Indifference point is that level of EBIT for which both the plans are having same EPS. So let us say interest in first plan is 30,000 and interest in second plan is 10,000. Okay. There's no preference dividend over here, but we have got a preference dividend of 40,000 over here. And the number of equity shares that we have in plan 1, the number of equity shares is, let us say, 12,000. And number of equity shares in plan 2 is, suppose, 10,000. So 30,000 is the interest and 10,000 is the interest. 40,000, 12 and 10, these are the figures for the respective uh, number of equity shares. Okay, so now I want a level of EBIT. I want a level of EBIT over here, which should be, of course, same. That will actually make my EPS also same. That should be also making my EPS same. So 12,000 number of equity shares planned to 10,000 number of equity shares. EPS is same. So I want a EBIT level at which EPS of both plans should be same. It means both the plans are indifferent. Irrespective of whichever plan I choose, I am having indifference between both the plans. Both of plans are going to give me the same amount of, they're going to give me the same amount of EPS. So can that be really possible? Yes, that's possible, guys. Sir, how can we do that? Let me just verify it for you. Let me just show it to you that how can that be possible, right? How can that be possible? Let us say I am giving you a number as EBIT of, let's say, 3,90,000. EBIT of 3,90,000. Profit before tax in plan 1, that's going to be 3,60,000, and this is 3,80,000. Tax rate at the rate of 50%. If you take the tax rate as 50%, this should be 1,80,000. And over here it should be 1,90,000. Profit after tax is 1,80,000, 1,90,000. Preference dividend, since it is nil. Net profit is 1,80,000. Over here net profit is 1,50,000. Divide, EPS will work out to be 15 for both the cases, right? So this amount of EBIT that we have, 3,90,000 and 3,90,000, those are called as the indifference points. 3,90,000 is that level of EBIT at which EPS is 0. Basically, this 3,90,000 is that level of EBIT at which EPS is equal, not 0. EPS is equal. We are indifference between both the plans. Sir, if you are getting EPS as 15 and 15, we'll say both the plans are equally attractive. No plan is dominating as such. No plan is, it's dominating as such, because EBIT is just one and the same. 3,90,000 is the EBIT figure, which makes the EPS as 15. It makes EPS as 15. Right? And that's the same for both the things. So such a level of EBIT is what we call it as indifference point. To put it in a very simple context, indifference point is that level of EBIT at which our EPS for both the plans is going to be same. Okay, so I just want to put up a formula over here, which is pretty simple, actually very simple. So looking for a EPS. Let's say I want to calculate the EPS figure by a form of an equation. I'll call that as EPS. Let's say EBIT is X. We'll say let EBIT equal to rupees X. So EPS can be computed as what? X minus interest, right? What is this X minus interest figure? What is this X minus interest figure? X minus interest figure is basically profit before tax, right? So this is our profit before tax. And then from that, we subtract the tax amount. Right? So we subtract the tax amount, profit before tax. From that, we subtract the tax amount. How do we compute the tax? Tax is some percentage of PBT. Tax is some percentage of PBT. So, sir, it is the tax rate. Is the tax rate multiplied with X minus interest, which is a PBT. From that, you subtract the preference dividend. X minus interest minus tax into X minus interest minus preference dividend. And you see this whole stuff is going to be further divided by number of shares. Now, of course, know this X minus interest is a PBT thing which we can take common easily. If we take that thing common, we get this as X minus interest into 1 minus tax minus preference dividend upon number of equity shares. Right? So this is the formula that we have for this is the formula that we typically have for the EPS equation format formula. It is quite easy and intuitive to understand, right? Now, this is exactly the formula that which we are going to use to compute this indifference point. Let us try to compute this indifference point for plan 1 and 2. If I ask you, sir, what's the formula for EPS of plan 1? We will say it is X minus interest of 30,000. X minus interest, or I'll just do one thing. Space it. Yeah. So EPS for plan 1 is going to be X minus interest, since the formula involves X minus interest. So for this plan 1, interest is 30,000. X minus 30,000 into 1 minus tax rate is 0.5% tax rate minus preference dividend is 0 over here. Then we divide this by 12,000. Then if you want to compute the EPS of plan 2, similarly, we can set the formula as X minus interest is 10,000. One minus 0.5, which is a tax rate, minus we have a preference dividend of 40,000 over here. Minus 40,000 divided by 10,000. Now our task is to equate both the EPS and get this X. We have to equate both the EPS and get this X. So we say EPS of plan 1 has to be equal to EPS of plan 2. And under this situation, we want to know what will be the EPS or what will be the EBIT, right? So since both of them are going to be equal, that's going to be X minus 30,000 into 1 minus 0.5 minus 0 upon, or rather, I can just say I am bringing this thing over here, right? And this is going to be equal to this EPS. Okay, and then based on that, we can say, sir, zeros will get cancelled, and we will have it like, even we can subtract this further and reduce this further as 5 and 6, right? And we can just go for cross multiplication possibly, but before that, let's try to simplify it further. X minus 30,000 into 0.5, because 1 minus 0.5 is 0.5, divided by 6 is equal to X minus 10,000 into 0.5 minus 40,000 divided by 5. Then we'll go for a cross multiplication. Cross multiplication is 5 into, or before cross multiplication, we can actually think of getting this multiplied inside. It actually becomes 0.5x minus 15,000 divided by 6 is equal to 0.5x minus 5,000 minus 40,000 divided by 5. Okay. So we have 0.5x minus 15,000 into 5 is equal to 0.5x minus 45,000 multiplied with 6. So we can just open it up. That becomes 2.5x minus 15 into 5, 75,000 is equal to 0.5 into 6. That's 3. 3x minus 45,000 into 6. 45,000 into 6. That will make it as 19 to 3, 2 lakh 70 probably. Yeah, 2 lakh, is it 2 lakh 70? No. 90 into 3, yeah, 2 lakh 70,000. Then you just rearrange the x and y's. 2 lakh 70,000 minus 75,000 is equal to 3x minus 2.5x. That essentially makes it as 0.5x is equal to 2 lakh 70 minus 75,000. So 2 lakh 70 minus 75, that's 1 lakh 95,000. And essentially x is 1 lakh 95,000 divided by 0.5. So we get x as 3 lakh 90,000. And can I say exactly the same figure we had as the indifference point over here, 3 lakh 90,000. So we can get easily the indifference point by simply equating the EPS figures. By simply equating the EPS figures and find the x. You can simply equate the EPS figure and find out the value of x. So x is 3 lakh 90,000. And that's actually what we say as the indifference point, or the point at which both the plans have got the same EPS figures, or you can say the plans are indifferent to each other. I hope this is clear to you. Is this clear? Are we clear how to get this EBIT of 3 lakh 90,000? Perfectly fine. Are we good to go? Yeah, understood. Okay, so that's how we get the indifference point between plans. So let's just do one thing. Let's try to solve a typical question, which is question number 11 for that case. Let's look at this question number 11, which is a very elaborate question to discuss a lot of things. Let's look at this question 11. Key information pertaining to proposed new financing plans of hypothetical limited is given below. Okay, so we have two plans. Financing plans are being planned out in two ways. In plan one, we are looking for equity shares to the tune of 15,000 shares at rupees 100 each, and preference shares, 25,000 preference shares of rupees 100 each amounting, sorry, or 12%. And this is the debentures. We have got a debenture of debenture to the tune of 5 lakh. There's just an alignment error. Understand that this is for the debentures over here. And plan 2 is 30,000 shares and 15 lakh in debentures. So let's talk about the capital structure as of now. In plan 1, capital structure is first one, it is 15,000 into 100. 15 lakh is the equity share capital. Preference shares, 12% preference shares, 25,000 of rupees 100 each. So that's like 25 lakh into 12%. Debentures, 5 lakh debentures at a coupon rate of 0.1. 5 lakh into 0.1, 5 lakh into 10%. Plan 2, it is 30,000 shares of rupees 100 each. That's 30 lakh. There's no preference share. Debenture of 15 lakh at the rate of 11%. Okay, 15 lakh at 11%. 45 lakh. 45 lakh is the amount of total cap. Another question. Let's look at the question. Assume 35% tax rate. Let's assume 35% tax rate. We have to determine two EBIT EPS coordinates for each plan. EBIT EPS coordinates means for a given level of EBIT, what will be the EPS, right? So in such case, we want two combinations. For plan 1, we want one level of EBIT, and for that, what will be the level of EPS? Just like X coordinate, Y coordinate in our geometry, right? So we want a coordinate as for a given level of EBIT, what will be the EPS? That's the first thing. Secondly, it says determine the indifference point, financial break-even point for each financing plan. Now, of course, indifference point will be for these two plans. Plan 1 and plan 2 will have the indifference points, and also break-even point for both of them. Which plan has got more financial risk and why? Indicate over what EBIT range, if any, one plan is better, and if a firm is fairly certain that EBIT will be 12 lakh 50, which plan would you recommend and why? Now, my question to you would be, I'll just wait for a couple of minutes for you to give me the financial break-even point for both the plans. Give me the break-even point for both the plans. I'll wait for you. Give me the break-even point. Don't look at this first question. First part of the question. First part we will discuss it later. But as of now, give me the financial break-even points. Again, just to remind you, financial break-even point formula is we have the same formula, which is preference dividend upon 1 minus T plus interest. Preference dividend upon 1 minus T plus interest. Okay, so preference dividend upon 1 minus T plus interest. Give me the financial break-even point for both the plans. Waiting for your answer, guys. Come on, tell me. Give me the break-even point formula. Break-even point, not formula. Give me the formula. Give me the answers for financial break-even point for both the plans. Okay, so Vinay is the first one to answer. Break-even point is 76,923 and 1,65,000. Is it 76,923? I get a confirming answer. Okay, so Alok is giving the answer as 5,11,538 and 1,65,000. Okay, this seems to be correct. Perfectly correct, guys. The interest is 50,000, 1,65,000. Preference dividend is 3 lakh. So that 50,000 plus 3 lakh upon 1 minus 0.35 and 1,65,000. Of course, higher the financial break-even point, no greater is the risk. That's pretty easy to answer, right? That's very easy to answer. So we are done with this part. The financial break-even point is what we have completed. Now we want the indifference point. And also we have answered this one, which has got more risk and why. So higher break-even point means higher risk. That's already specified. Now we want to go for indifference point. And how do we get the indifference point? By equating the plan's EPS. So I'll just give you the equation. I want you to solve it first. Okay. So we know EPS of plan 1. EPS of plan 1 is going to be the EBIT figure minus interest of 50 into 1 minus 0.35, which is 0.65, minus 3 lakh preference dividend. And that's equal to X minus 1,65,000 into 0.65 upon 30,000. Okay, so I want you to equate both of them and give me the indifference point. Go on, guys. Give me the indifference point, or I can say compute X in this case. Compute X. Calculate the value of X over here. Calculate the value of X, guys. Eight lakh 58,076. Is it 8,58,076? Yes, it seems to be. We can just say we just cancel it by 2. No, and then that 0.65 gets inside this. Just multiply it by 2. It's just arithmetic calculation, right? Should be getting this as 8,58,076. Just see if you're getting this answer. 8,58,076. 8,58,076. Yeah, 8,58,076. Are you able to get this answer? Praneev Vashishta has got this answer. Anyone else? The indifference point at 8,58,076. Anyone else got it? Yeah. Have you got this answer? Only just one guy, Praneev Vashishta, has got it. No one else? Okay, Danish has also got it. Quite a few of them. Okay, so that's the indifference point. So we know that this is the indifference point at which our EPS for both the plans is just going to be the same figure. 8,58,076 should be the EBIT at which EPS of both the plans is one and the same. Now, let's try to get in detail as to what this number really helps us. We'll understand it with the help of this diagram. On x-axis, we have EBIT figures. We already have for plan 1 the break-even point. Right? For plan 1, we have computed the break-even point as 511,538. We had for plan 1, the break-even point is this point, 5,11,538. For plan 2, it was 1,65,000. So undoubtedly, plan 2 would be break evening first, would be entering the break-even or would be crossing the break-even zone initially. And it will take some more amount of EBIT for plan 1 to break even. So plan 2 would be break even, going for a break even at an early stage. Plan 2 would be going for break even at an early stage, and plan 1 would break even at a later stage. Now, there is this indifference point, which we got it as 8,58,070. So what does that mean? It simply means that before 8,58,000, before 8,58,000, you will find that plan 1 and plan 2, out of these two, plan 1 is actually dominating. Okay? This plan 2, before 8,58,000, it is in the dominant. After this 8,58,076, plan 1 starts dominating. So, if I ask you out of plan 1 and plan 2, which one was more risky? Out of plan 1 and plan 2, which one was more risky? Of course, we have stated in our break-even calculation also that plan 1 was more risky. So since plan 1 was more risky, it is never going to be a feasible thing at a lower level of EBIT. When your EBIT level is less, you will never go with a plan which has got a greater risk in it. You will go for a plan which has got less risk in it. That's plan 2 for you. So that's plan 2, where you find that the risk is lower, and that is good at, when you're earning EBIT at a lower level. When your EBIT increases beyond a limit, but plan 1 starts dominating. Okay. So we need to understand that if our plan is less risky, so a situation where EBIT is less than indifference point is suitable. So if the plan, as we said, the plan 2 was less risky. So we find that it is in a dominating position, or it is on the upper line before indifference point. And plan 1 stays in the upper position when it is beyond indifference point. So understand, if plan is less risky, EBIT less than indifference point is suitable. If plan is more risky, EBIT greater than indifference point is suitable. To make it even more clearer, we have this table over here. We have the indifference point, 8,58,076, 8,58,076, and this is 9 lakh and 80. So this is the indifference point. This is what our indifference point is. This is less than indifference point, and this is greater than indifference point. If we just try to calculate the amount of EPS that we get over here, we'll draw some conclusions, right? Let's try to calculate the EPS. So let us say EBIT of 8 lakh. Over here also 8 lakh. If you look at the amount of interest, in plan 1, we had the interest amount as 50 and preference dividend as 3 lakh. So interest is 50. Interest amount is 50,000. And so we get a PBT of 7 lakh 50. Then we have a tax at the rate of, I hope it was, what was the tax rate? That's 35%, right? So if you take a tax rate as 35%, so 7,50,000 into 35%, that's 2,62,500 minus 7,50,000. That's 4,87,500. Then from that, we're going to subtract the preference dividend. Preference dividend amount over here, it was 3 lakh. And dividing that, subtracting that 3 lakh, we get 4,87,500 minus 3 lakh as 1,87,500. 500, and the number of shares that we had over here, it was 15,000. So just divided by 15,000, that's 12.5 as the EPS. Same way, if I go ahead with the calculations for plan 2, we get that interest is 1,65,000, and we get a profit before tax as 8 lakh minus 1,65,000 as 6,35,000. Tax is at the rate of 35%, so that works out to be 2,22,250 minus 6,35,000. That's 4,12,750. From that, there's no preference dividend, by the way. So net profit, this is entirely our net profit, 4,12,750. But here the number of shares was 30,000. On computing, we find that it is 13.75. What we observe is when your EBIT is less than indifference point, when the EBIT level is less than indifference point, plan 2 is having a better proposition in terms of EPS. And that's what we are observing over here also. When your EBIT level is below indifference point, this portion, the first portion, the upper hand is there with the plan 2. Now, of course, without any further justification, we can say that EPS is going to be same for both of them if our indifference point is considered. So at an indifference point, if you take a EBIT figure as 8,58,076, 8,58,076, I'm pretty sure that you will get a same level of EPS, because that's how we have computed the EBIT figure. Now, at an indifference point of 9 lakh, what we observe is that it's 16.83 and 15.925. That's 16.83, 15.925. So over here, 16.83 is dominating, or plan 1 is dominating. So plan 1 dominates at a higher EBIT. So this concept is similar to our capital gearing concept that we had learned in ratio analysis, in which we stated that it's better to have a high gear, or you can prefer to take more risk if you have a good degree of EBIT, or I can say when your earnings before interest and tax is higher. When your earnings before interest and tax is to a greater extent, then it makes sense to take risk. If your EBIT is not higher, then it will be a bit difficult for us to take risk. But if you take risk, then you will fall short of the resources to run your business, and ultimately you may find that you are making losses. So many businesses that are into high degree of EBIT, they'll prefer to take more risk, right? So indifference point is that point which actually tells you that what is that threshold EBIT that you need, beyond which it makes sense for you to take risk or take more debt. Okay. So if you look at the question now, determine two EBIT EPS coordinates. We have already done this. So for 8 lakh, EPS is this. For 8 lakh, EPS is this for the plan 2. Similarly, for 8,58,076, this is the EBIT, this is the EPS. Same way for 9 lakh, this is the amount of EPS. So we have actually given them three EBIT, three coordinates instead of 2. Determine the indifference point, financial break-even point, that is done. Which plan has more financial risk, that is done. Indicate what EBIT one plan is better than other, that is what we have stated over here. If your EBIT is less than indifference point, that is 8,58,000, then the plan 2 is better, and beyond that, plan 1 takes the lead. And finally, if the firm is fairly certain that EBIT is going to be 12,50,000, which plan would you recommend? So if you're sure that you're going to have a EBIT of 12,50,000, which is obviously above this 8,58,000 figure, above this 8,58,000 figure, so of course you should go for plan 1 in that case. Okay, guys. So that is what we have covered, the concepts of the indifference point, the break-even point, and also seen how to evaluate the financial plans. We would like to stop here for the day, but before that, let me see if there are any queries. Okay, there's no set of queries as such, but still I'll wait for a couple of minutes. If there are any queries, please do post it on the chat box. So I'll upload this full PDF file on the portal. Need not worry, because we have one more session on capital structure. So there are many questions which we haven't yet solved from this part. We'll be solving them in our revision class of ratio analysis and capital structure. Okay, in the next class of capital structure, we'll be learning about the capital structure theories. Okay, capital structure theories, where we are going to be getting entertained by the debate that's going on between a two separate set of intellectuals. Okay, so with that, there's no set of queries as of now, so we're good to stop here for the day. See you in the next class, guys. Till then, bye bye and take care.